I'm going to go through a bit of philosophy, what kind of makes this different from traditional technical analysis and trading, as well as what we're looking for as VWAP traders. When I first started looking at the markets, I remember thinking that the market always had to be long or short, that there was always a direction, and if I just got that coin flip right, then naturally I'd be aligned with the way the market was moving, and I was going to make money. And of course, it wasn't quite that simple. You've heard me say this before, that the market is a different binary than we've been taught. It's not long and short, up versus down, but rather random versus non-random. Or said another way, chop versus trend. So if we look at, let's call it counter trend, or CT as an abbreviation. A very sideways, fickle market is the opposite or antithesis of a trending market. Now, just at a glance, there are going to be a couple things that are different about these two styles or types of market that we're trying to differentiate between. You'll notice that the counter trend VWAP is very flat, whereas the trending VWAP is moving in a direction. It is sloping. You'll notice that the deviation bands are not very far apart and barely widening over the course of the day in a counter trend market. They're very contained. During a trending market, however, they expand and grow over the course of the day. And then finally, in a counter trend market, we don't expect much chart movement outside of one deviation. We're going to tend to be contained within the one deviation band in either direction for a counter trend day or a counter trend market. During a trend move, however, we expect kind of the opposite. We expect a lot of time to be spent outside or further away from VWAP with respect to the 1 or -1 deviation band. So again, here's our 1, and here's our -1 deviation band. So let's draw that as a basic example for everyone to kind of see, almost like a textbook example of it. During a counter trend market, we're going to have a flat volume weighted average price. We're also going to be oscillating. I'm going to pick a different color here. We're going to be oscillating on both sides of the VWAP rather than picking one side of the VWAP or the other. That's what you can see over here during a trending market. We've gotten below the VWAP and we're not going anywhere above it. And then finally, we expect to be relatively contained within the deviation bands. Sorry, that drawing is kind of crappy, but you get the idea. During a counter trend market, so another example of which we've already kind of highlighted from back here, you can see it meets all the characteristics that we're expecting. It's a relatively flat volume weighted average price, no real slope on the slope indicator. We are oscillating on both sides of the VWAP, and we are contained within the deviation bands. Notice how dramatically different this example or this example looks from something like a trend environment. So for a trending market, as I said, we've got a sloping or directional volume weighted average price. We're going to pick one side of the VWAP to exist on. Now here's where it gets a little confusing. We may see some containment within the deviation bands, just as we'd expect during a counter trend market. But, and this is really crucial, once we break down, or directionally in whichever way we're heading, we're going to expect to see that same containment to the outside and away from volume weighted average price. So just to reiterate, what is the VWAP slope doing? Is it flat or trending? What is the market doing? Are we chopping on both sides of VWAP, or are we on one side of the VWAP or the other? And then are we contained within the deviation bands, or are we trying to break outward and move away from them? So here's the key philosophy or philosophical, element that I'm trying to express. Like a magnet, we can be attracted back towards the volume weighted average price. And that will tend to occur during counter trend or choppy markets. So the safer trades are effectively back towards the volume weighted average price. During a strong trend, the opposite is true. Like a magnet repelling us, the safe trades are directionally away from volume weighted average price rather than back towards it. So when I was saying before, we think about the market as this kind of long, short binary. It's not that simple. Well, maybe it is. It's a binary, but it's not that binary. It's a battle between trend, which means movement away from the average, and non-trend or counter-trend or chop, which is oscillation around the average. So what we're really trying to figure out is the style of the market, meaning is it counter-trend or trend? Its direction, so that means long or short, and the likelihood of continuation or perseverance. Is it going to revert, which is more like a counter-trend market where we're likely to come back to the VWAP? Or is it more of a trending market where we're likely to continue doing whatever we've been doing and trending in that direction? This is important because VWAPs define the trend for the day. In the event that the market is oscillating on both sides of the VWAP, that kind of tells you that we aren't really picking one direction to trend or the other. We're quite simply oscillating around that central average. During a strong trend, however, and so I'm drawing yet another kind of random hypothetical example, but during a strong trend, if the market continues to retreat to the VWAP before making progress in a direction, so here I should have drawn these in different colors, but you get it. Here's our price action, and then here's our volume weighted average price. VWAP is the point to which we are likely to return before resuming directional movement, before continuing to the downside in each of these instances. VWAP is effectively the place where sellers are going to resume their activity, trying to enter the market at as close to the average price as they can. Because VWAPs define trends, markets that don't abide by a VWAP, meaning markets that cross and oscillate a VWAP, are telling you something, even though that's not a clean directional trading signal. It's warning you that the market has not yet picked a direction. When the markets do abide by a VWAP, meaning they come close to a VWAP before resuming their directional trend, what that's showing you is that there is a heavily demarcated and well kind of defined area that other larger traders seek to attack the market. And that makes for a really safe place for we independent traders to participate in that trend. And when I say participate, I'm sure you guys can all kind of put 2 and 2 together. What we mean is we wait for a little bit of confirmation, a little bit of rejection, and then we can go short with a stop just above the prior structured high. What that allows us to do is take a very small amount of effective risk for a lot of potential gain. And we're not getting into risk reward just yet, but I think you guys can see what I'm trying to get at more broadly. We're trying to find a safe place to resume market's trending behavior, and for us to get aboard with some distinct or obvious support or resistance. One thing I like to say about this is that VWAP critically frames the market for us, and it automatically does this. It makes for a kind of familiar or repeatable method for any chart that we're going to be looking at. And the reason I think this is really important is because, guys, let's face it, you're looking at a lot of different stocks every day, especially if you're a more momentum trader or a small cap trader. You're trading variable, disparate stocks every single day. At least with large caps, and by using volume weighted average price or something that's going to apply a familiar framework, you're always looking at a kind of consistent grid or framework for you to have some context for what the market is really doing. It's almost like, and we'll again get to this, we still haven't quite described it, but it's almost like lanes on a road. Let me go ahead and clear this off real fast. Like lanes on a road. So you can see here we've got our main divider line in the center, and then we've got our lane dividers showing both the fast lane in either direction and the slow lane in either direction. Now I know that doesn't quite fit with how traffic works, but think about the analogy there. Lanes on a road are a way of grouping a bunch of otherwise unpredictable things, other people driving their cars, into a familiar framework that anyone can quickly make sense of. Can you imagine driving on a road without lanes? You'd have no context. You wouldn't know where you belong or where someone's trying to drive or how fast they're trying to go or whether you need to be careful of them or not. Lanes effectively thematically group data for us. They group that data according to the story of that car. Is it trying to drive faster? Is it trying to drive slower, etc.? VWAP and standard deviation bands do a very similar kind of thing with any chart that we apply it to. It kind of puts you at a real advantage because you've seen not only the shape of VWAP before, but you've seen these kind of familiar price action patterns as they react to the support and resistance of the standard deviations. And if you remember from a little bit ago, when we went in and achieved that highlighting by setting this to fast lane instead of cloud, now hopefully it makes a little more sense why the area outside 1 or -1 deviation bands is indicated as the fast lane, as we call it. We call it the fast lane, obviously, because we anticipate more aggressive price movement to happen during the areas of fast lane travel, rather than when we are stuck kind of in the slow lanes so far. So I guess the last point within philosophy that I wanted to make is that VWAP is both a technical, like entry and exit indicator, but simultaneously it is also a market type identifier, meaning it may not give you a trade, but it may help you to determine what's the overall structure of the market, what direction are we likely headed, how believable or credible is this kind of movement. VWAP absolutely is kind of designed for, in the way we're using it, as a trade entry tool, as something that's going to get you into a technical trade. But I still use it predominantly as a way to read through and kind of quickly scan a market or chart and make sense of it on the fly. Meaning, is this even a trade I want to take? Is this even a chart I want to be observing for a potential trend? Rather than simply, where's the price pattern? Where's the price pattern? You know what I mean?